To begin, welcome to our deep dive on balancing saving and investing when short-term goals are approaching. In this video, we will explore how to prepare for near-term expenses while still building long-term wealth. We will walk through rules of thumb, account prioritization, example budgets, and a practical step-by-step plan. Additionally, we will include interactive quizzes to check your understanding and finish with key takeaways you can put into action immediately. Next, here is our roadmap to keep us organized. We will start with the significance of balancing saving and investing, then move into a core framework and decision flow. After that, we will cover tax-advantaged accounts, short-term liquidity, and a sample monthly plan. Then, we will lay out a step-by-step action plan, discuss investing aggressively where appropriate, and reinforce the ideas with diagrams. Finally, we will include quizzes, summarize key points, and wrap up. Now let's discuss why this balance matters. Near-term expenses and long-term investing often feel like a tug-of-war. If you only save cash, you might lose out on compounding. If you only invest, you might lack liquidity when the bill arrives. Striking a calculated balance helps you meet near-term goals while preserving momentum toward retirement. Moving on, here is the core idea. For money you will need within 5 years, prioritize liquidity to avoid market timing risks. For long-term goals beyond 5 years, emphasize investing in diversified low-cost index funds. Always build your emergency fund first, typically 3 to 6 months of expenses. Once you know the monthly amount needed for the upcoming event, allocate that to a high-yield savings account. Then, direct the remaining surplus to investing. Keeping expenses low and investing consistently allows compounding to work over time. Before we proceed, a brief disclaimer. This content is educational and not financial, legal, or tax advice. Your situation is unique, so consider consulting a qualified fiduciary financial advisor or tax professional before making decisions. Additionally, always prioritize tax-advantaged accounts where possible. If your cash flow allows, contribute to Roth IRAs and take advantage of employer matches in workplace plans. Strive to reach the annual maximum contribution in your Roth IRA as circumstances permit. Also, be mindful of fees, since high costs can compound negatively over time. While you prepare for near-term goals, try not to miss the powerful long-term benefits these accounts offer. Next, let's compare where to place your dollars. For short-term needs under 5 years, high-yield savings accounts serve as the primary vehicle for both emergency funds and specific event funds. If your timeline is certain, short-term certificates of deposit or treasury bills can be appropriate. The focus here is capital preservation and easy access. In contrast, for long-term objectives beyond 5 years, low-cost diversified index funds in a general brokerage or tax-advantaged accounts are typically suitable. This approach emphasizes growth and compounding over longer horizons. Now let's focus on short-term liquidity. First, build a 3 to 6 month emergency fund in a high-yield savings account. Next, open a separate sub-account or bucket for your specific event to avoid mixing funds. Then, calculate the total cost and the months remaining to set a clear monthly savings target. Automate transfers to reduce frictions. After you are on pace for your event and the emergency fund is at target, allocate any remaining surplus to your investment accounts. To illustrate, here is a sample monthly budget for different income levels. Essentials are shown at roughly 50% as a guideline. The emergency fund and event fund are directed to a high-yield savings account until their targets are met. Roth IRA contributions are continued based on available cash flow, and remaining dollars flow into a general brokerage invested in low-cost index funds. Finally, a modest discretionary category is included. These numbers are illustrative. Adjust to your locality, obligations, and the current annual contribution limits. After that, visualize your plan on a timeline. The diagram should show a planning phase with tasks like setting the budget and opening the high-yield savings account. Then, during the saving phase, track milestones such as the first $1,000 saved, the halfway point around month 6, and the full target by month 12. Finally, mark the execution phase for paying deposits and completing the event. This structure helps you maintain momentum and monitor progress month by month. Furthermore, here is a practical 7-step plan. First, determine the event's all-in cost and deadline. Second, ensure your emergency fund of 3 to 6 months is in place within a high-yield savings account. Third, set an automated monthly transfer to meet the event savings goal on time. Fourth, continue funding tax-advantaged accounts as cash flow allows. Fifth, direct any remaining surplus into low-cost index funds in your general brokerage account. Sixth, reduce unnecessary expenses to accelerate savings and investing. Seventh, review your progress monthly and rebalance contributions if your situation changes. Meanwhile, when your timeline permits, invest aggressively by favoring low-cost, broadly diversified index funds rather than speculative bets. Automate contributions to remain consistent, and consider dollar-cost averaging to mitigate timing risk. Emphasize time in the market rather than attempting to time the market. Additionally, a pie breakdown gives you a quick way to see if your budget aligns with your goals. You can increase the event fund slice as the deadline approaches while maintaining contributions to tax-advantaged accounts. Adjust percentages as your income and priorities evolve. Now, it is quiz time. The question is, if you need the money within 3 years, where should the bulk of it typically be kept? The options are A. In individual growth stocks, B. In a high-yield savings account or other highly liquid, low-risk vehicles, C. In a long-term bond fund with high duration, or D. In cryptocurrency for higher potential returns. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. Next, the correct answer is B. For goals within 3 years, prioritizing liquidity and principal stability is key. High-yield savings accounts, short-term CDs, and treasury bills are suitable examples. Now for the second quiz, consider this situation. Once your emergency fund is at target and your monthly event savings is automated, where should the remaining surplus generally go? The options are A. Pause all investing to stockpile only cash, B. Increase discretionary spending first, C. Low-cost index funds in a brokerage account, or D. Expensive ceremonial purchases to signal wealth. You may pause the video now to consider your choice. We will discuss the answer in the next section. Moving on, the correct answer is C. After funding your emergency cushion and automating the event savings, funnel the remaining surplus to a general brokerage invested in low-cost diversified index funds to maintain long-term compounding. At this point, let's consolidate key takeaways. Balance is essential. Reserve liquid funds for sub-5-year goals and invest for longer time horizons. Do not ignore tax-advantaged accounts and aim to reach the Roth IRA maximum when feasible. Build a 3 to 6 month emergency fund in a high-yield savings account. Set and automate a monthly event savings target. Then, allocate remaining surplus to low-cost index funds. Finally, keep expenses low so that compounding can play a greater role. Finally, let's wrap up. You can meet near-term milestones without undermining your long-term trajectory by following a simple decision framework. Automate both savings and investing to reduce friction and sustain momentum. Review your progress monthly and adjust as your circumstances change. With discipline and clarity, you can fund your event and continue building wealth. Before we close, thank you for watching. If this video was useful, please like, share, and subscribe. In the comments, let us know your next short-term goal and how you plan to balance it with investing.